On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. All right, morning all. Just looking back on last week, it was a more difficult week for financial markets than we've seen in a little while. We had the S&P 500 index in the US fall 2.3% for the week. That's actually the worst weekly performance we've seen in almost 5 months. You've got to go back to mid-March to find a more difficult week. So the stellar run that we've seen of late, the US market has rebounded more than 25% from the lows from October 2022, and it's up 16.6% year to date, even after that sort of soft week. I wouldn't go as far as to say that run's come to an end, because there are some reasons to be optimistic about the future, but definitely a breather. Market definitely taking a breather. So I think a couple of reasons for that. We had that slightly weaker than expected result from Apple, which is a real market heavyweight. Amazon had a great result, but Apple's result wasn't taken quite as well last week. That was a bit of a catalyst for people to take a few profits and just get a bit more cautious. You also had a slightly softer jobs report, which I'll talk about soon, and that also pointed to quite persistent inflation pressures. You also had bond yields rise. So the US 10-year Treasury yield actually hit the highest levels that we've seen since November last year. It was about 4.2-ish, I think it got to during the week. And it's the highest since before Christmas last year. We also had rating agency Fitch lower its long-term foreign currency issuer default rating, credit rating essentially, for the US from AAA to AA plus. So all of these things were just reminders to investors that even though we've seen a great performance from markets across the board in 2023, there are still risks out there. The volatility isn't all behind us. So a more difficult week for the US market, down 2.3%. Other markets followed suit. Europe was down a little more than that, actually. It was down about 2.4. The UK off about 1.7. The Aussie market across the Tasman off about 1.1. And interestingly, the New Zealand market, the NZX 50, as is often the case, was more resilient. We were pretty much flat, just went sideways. So even though we don't always follow other markets up, when you've got the likes of the US or Europe or even Australia powering ahead, sometimes we can be a little more subdued. There is a positive side to that resilience, that defensiveness, because it's not uncommon to see international markets fall and our market to hold its own. And that was certainly what we saw last week. US 2-year Treasury yields fell from 4.9 to 4.8. The 10-year, like I said, it actually hit the highest level since November last year, but it ended the week at about 4%. So higher, but only about 8 basis points higher than where it started the week. So not a dramatic move. Local interest rates, we had the 5-year swap rate here in NZ rise slightly. It rose to 4.9%, so not a dramatic rise, just sort of drifted higher. That did sort of push the corporate bond index down ever so slightly, but the NZX corporate bond index, which is a good proxy for fixed income as an asset class, domestic fixed income, that is, it's still done about 2.8% so far this year, and the NZX 50, the share market index, done about 4.1. So both of them are up slightly in 2023, not performing as well as some of those other international markets, but still doing their job. Looking back at all of the economic releases and news flow and central bank decisions last week, and it was another busy week. There was plenty going on. We'll start here at home. Business confidence continued to edge higher. We had the ANZ Business Outlook survey, and sentiment rose. So we had headline confidence improve from -18 to -13.1. Still low, still below the long term average, but it's the best since October 2021. So that's good. Had the own activity index dipped slightly, but it stayed in positive territory for the second consecutive month. And it's pretty close to the highest levels we've seen since early last year. So that's good. It does tell us that firms are in better spirits. They've still got plenty of things to worry about, but they're in better spirits than they have been in some time. Inflation indicators still elevated, still telling us that inflation is high, but they continued to ease as well. And we saw that in the pricing intentions part of the survey. We saw that in terms of wage settlements, and this is something sort of that I think a lot of us are hearing anecdotally as well. You talk to business people, you talk to business owners, and they do tell me at least that it is a lot easier to get staff. I spoke to a small business owner just today, and he said that things had turned around quite a bit in terms of the ability to get staff. He's full; he doesn't need any staff, but he's actually got a waiting list now of people that want a job with him, which is quite a turnaround from 6 months ago, 12 months ago, when there was certainly no waiting list, and he was in a much more difficult position if he was looking to hire someone. So we are seeing things move and the labour market ease up a little bit, and that is good because it is feeding through to more subdued wage increases looking ahead, and that's important because it is a key piece of that inflation puzzle, and that's what the Reserve Bank needs to see for it to feel comfortable with the direction of travel, and for it to stop increasing the OCR and potentially reduce it at some point. Speaking of the labour market, we had the June quarter labour force report last week too. And again, a bit of a mixed bag. The labour market remains strong, but there are signs of easing there. So the number of people employed actually rose quite strongly. The number of people employed rose 1% in the June quarter. So that's very high. However, the total labour force grew by more than that. So you've got more people getting jobs, but you've also got the labour force growing because migration is up, some more people coming into the country, and you've got increasing participation, which means maybe people that sort of were happy to remain retired, or sort of maybe they had a working partner or spouse and they were happy to sort of not be working. A lot of those people are now available for work. They would like a job, so they're probably being enticed into the labour market for a couple of reasons. Obviously, better pay and better conditions because we've had some good gains in wages, plus the cost of living. Some of them will have to go out to work or will have to increase their hours. So higher migration, higher participation has increased the labour force, and what that's meant is that even though there's more people employed, the unemployment rate actually went up a little bit. It increased to 3.6%. So it's 3.4 3 months earlier, and it's gone from 3.4 to 3.6. So that's a bigger uptick than expected. People were expecting it to rise to 3.5. It rose to 3.6. So still very low by historic standards, although the highest in 2 years, and certainly well above that multi-decade low of 3.2 that prevailed early last year. So I think that's probably good news. You do need to see the labour market ease up a little bit. So that's one way of saying we actually need a little bit of unemployment to get this inflation problem under control. But it's much more desirable for that increase in unemployment to come because you've got more people coming into the country and more people making themselves available for work than because you're seeing layoffs. So I guess in a roundabout way, it's a rise in unemployment that is better than some of the ways you find yourself with a higher unemployment rate. So not all bad. I think the Reserve Bank will be pretty comfortable with that. what else did we see? We had the wage growth that comes out as part of that survey, and there's a few different ways you can measure it, but just to take average hourly earnings for the private sector, that increased 1.9% for the quarter, so it's a little bit slower than we saw in the previous 3 months. And on an annual basis, average hourly earnings up 7.7%. So that's still very strong, but the better news, it was 8.2% in the previous quarter, and it was 8.6 at one point last year. So it's coming down, and that will be pleasing the Reserve Bank as well. That the direction of travel is the right one, but as we've seen with lots of other indicators, including the CPI report, we're just not seeing things come down quite as quickly as the Reserve Bank would like. So when is the Reserve Bank next meeting? I think it's next Wednesday, actually. So not this week, but next Wednesday. And no one's expecting a move at that point. In terms of the OCR, it's expected to remain unchanged at 5.5%. However, markets still see about a 40 or 50% chance of one final hike from here, maybe in November, which would be the last meeting of the year. That would take the OCR to 5.75%. So what we'll be really interested in next Wednesday will be less sort of the decision, but it'll be that new set of forecasts that we'll get, because it's also a monetary policy statement. So we'll get the OCR decision, and we'll also get the new set of forecasts. So what we'll all be looking for in there, lots of things that we'll be keeping an eye on, but one of the most important will be that we'll all head straight to the part where they have a forecast for the OCR, and we'll want to know, has it changed since the one that we saw in May? Because in May, the Reserve Bank was saying 5.5% is the peak, and we're already at 5.5%. So have they held firm in that regard, or have they looked at some of these things that economists out there, from the major banks and so forth, what they're picking up on, and has the Reserve Bank sort of adjusted up that OCR path? So that will be really important. And last week's labour force report, gave us some more information about what we might get. Final thing, but probably one of the biggest things, and this came out on Friday. Wednesday and Friday, dairy sector news. So we had the latest GDT auction results, and they were expected, and they came out on Wednesday. The headline GDT index fell 4.3%, which is the biggest decline in about 4 months. And we've now seen prices fall at 5 out of the last 6 auctions. So you've got prices that are at their lowest levels since September 2020. They're down 13% this year, down about 42% compared to last year's 15-year highs. And what that told us was, geez, the Fonterra payout is the forecast payout, I should say, is just looking a little bit optimistic. And sure enough, 2 days later on Friday, you had Fonterra come out and say, we've cut it, we've revised it lower. So the opening forecast for the current season, so the 23 and 24 season, had a midpoint of $8, because they give you a range. So it was $7.25 to $8.75. And the midpoint was $8, and they've cut that quite sharply. Cut that to a range of $6.25 to $7.75. So now you've got a midpoint of $7. So, long story short, they've gone from 8 to 7, which is a bigger decline than we were all expecting. Most of the banks are in the sort of mid to high 7s. I don't think any of them were as bearish as thinking that the new payout would be 7. That's about a 12.5% decline if it eventuates. Remember, it's just a forecast, and the season's still got a ways to go. So, you'll get updates. You might see a rebound in prices. You might see the Kiwi dollar fall to sort of offset some of it. Who knows? But that's a hefty cut in terms of what Fonterra was predicting before and what they're predicting now. It's about a 12.5% decline. And if it does come through at $7, that'll be the lowest payout since the 2018-2019 season. So, you're going back 3 or 4 years. Not terrible. $7 is not the end of the world. but for a lot of farmers out there, that might not cover their costs. If you're holding a lot of debt, your interest bill has gone up substantially. Lots of your other costs have gone up, whether it's input costs, whether it's labour costs, whether it's compliance costs. If you've got to irrigate, you've got a higher cost structure. So for some farmers out there, probably a reasonable portion of them, $7 might see them sailing pretty close to the wind, or even actually below break even, which means they might need to sort of, borrow to sort of fund the gap. So that's a big deal, quite a big deal that we've seen that sort of cut. And the reason Fonterra gave was the impact of reduced demand from China. So obviously China isn't in a great spot, and that's impacting demand for our products. Interestingly, the Fonterra share price actually rose last week. So, a few people might have been confused by that. But what you've got to remember is that the milk that Fonterra buys off farmers that's a cost of production to them. They're not a dairy farming company. They're a processor. So they buy that milk and they turn it into something else and they sort of on-sell it. So they aren't sort of a farm owner as such. So, sometimes what's bad for farmers can actually be good for Fonterra. So if anyone's wondering, this seems like bad news, why'd the Fonterra price go up? Then that's why. It's not owning Fonterra shares is not a proxy for owning a dairy farm. It's a processing company. The other thing I would note there is that traditionally the currency tracks the dairy price pretty closely, as it would. We're just a big farm at the end of the day, and when our key commodity export is doing well, we tend to do well and the country's in better shape. So there is a strong relationship between the New Zealand dollar and global dairy prices. So I think with dairy prices obviously having softened, and with the Fonterra payout now looking not nearly as high as it was before, or as high as it was last year or the year before that, that's definitely a negative for the path of the Kiwi dollar. And that is also sort of good and bad. Lower Kiwi dollar, good for exporters, makes them more competitive, farmers included, because it offsets some of those declines. It's good for sort of some of the other exporters out there, but not great for the Reserve Bank, because that means that our tradables inflation, our imported inflation, is potentially a little bit higher. So there's lots of moving parts when you start thinking about the impact of lower dairy prices. We won't go into all of them today, but those are a few things. So that definitely caught my attention last week. Elsewhere, Reserve Bank of Australia, no change. They left their cash rate unchanged, so it's at 4.1. That wasn't a huge surprise because inflation has come in a little softer than expected. So the panic over rising inflation has subsided just a little bit. But from here, there's a good chance we still see one additional hike. Another 25 basis point hike is quite likely. That would take the RBA to 4.35, still quite a ways below us. So that's a watch this space. They meet every month, so we'll just keep monitoring. But no change last week. The Bank of England, though, on the other hand, did hike their policy interest rate by 0.25%. So that was their 14th meeting in a row where they hiked rates. Takes the BOE policy rate to 5.25%. That's the highest since early 2008. They've still got very high inflation, although it has come in lower than expected lately. It's still sitting at nearly 8%. So very high. Not as bad as it was. It was north of 11% late last year, but still very high. So in terms of where to from here, financial markets still see probably two more hikes coming from the Bank of England, 2 more 0.25% hikes, which would take their policy rate to 5.75%, sometime in the next 6 months. So that is where they're at. Economic data, we had a lot come out of the US, where the ISM indices, so the manufacturing index, still weak, still soft, rose marginally, but for the 9th time it's been below 50, and that points to contraction. So the index now is sort of at the lowest levels we've seen since the height of the pandemic in 2020. And if you ignore the sort of 2 or 3 months of that period, then we're at the lowest levels since 2009. So not fantastic news. More of the same though. Really, it's been that way for sort of 8 or 9 months, and um, typically people would have looked at that and said, geez, we must be in recession with the ISM manufacturing index being so soft. But I think what's changed in recent decades is the US economy is less based around manufacturing and it's much more based around services. So the services sector is much bigger than it used to be. Manufacturing used to be everything, and these days manufacturing, I think, is about sort of 8 or 10% of the economy. After World War II, it was probably 50%, but 8 or 10%. So it's still a good leading indicator. It's still important. It still tells us a lot, but it's just not as relevant to the bigger picture. And on that note, the services ISM was much more robust. It slipped from where it was before, but it's still north of 50. And apart from 1 month last year, I think December, it has been above 50 since June 2020. So for more than 3 years, a little more than 3 years, it's been pointing to expansion. So that's kind of offsetting the weakness you're seeing in the manufacturing sector. We also had the US jobs report. This was for July, came through on Friday. Jobs growth slowed, so the economy added 187,000 jobs. That's a lot, but remember, they're a very big economy. So relative to the size of the US, what have they got? 350 million people, something like that. It's actually quite a low number, and it's not far off the lowest since 2020. So a little bit softer. Headline unemployment slipped from 3.6 to 3.5, so it's sort of oscillating in the mid threes, still very low compared to history. But you are starting to see the labour market just slow a little bit. Average hourly earnings, though, was a little bit higher than expected. So, again, like New Zealand, it's kind of a mixed bag. You're seeing a little bit of softness in the labour market, which is what the central bank wants to see to give it confidence that inflation will be coming under control. But they're not sort of seeing quite enough weakness in the wage figures. So, still some work to do. And probably the final piece of economic data we got last week was out of China. We got the PMIs for July, and they were fairly weak. And I guess that's been reflected in what we've seen in terms of the dairy sector. But China is still doing it tough. It still hasn't recovered from 2022. Remember, it was closed for pretty much all of last year. COVID restrictions. So it hasn't bounced back like expected. You've got the property sector that's in a bit of a tough spot, and demand for the rest of the world's products has fallen as a result. So we're feeling the brunt of that in terms of our dairy products, but there'd be other commodity producers that are maybe feeling just a little bit less demand from China as well. Looking ahead, not as much going on this week. The highlight internationally will be the US CPI. So that's out overnight on Thursday. Markets are expecting the headline inflation rate and the core inflation rate to have both increased by 0.2% for the month, which would be the same as June. That would see the headline CPI increase at an annual rate of 3.3. And that'll be up from what we saw in June. In June, it fell to a 2.5 year low, or a 2 year low at least, of about 3%, or exactly 3%, which was well down from what we've seen for the last couple of years, and well down from the peak of 9.1 last year. So that's actually expected to tick up again. It's been going down, 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 and down, come down to 3. Now it's going to sort of tick back up to 3.3. So I think the lesson for us there is that a lot of the easy wins are behind us in terms of getting inflation down from high single digits to low single digits. A lot of that's because of things like oil and used car prices, which were very high, and they've come down a lot, but you've still got that sort of more persistent sort of element of inflation, which is going to be tougher to get under control. So, it's been the way to sort of think about it maybe is it's been easier to get it from sort of 6, 7, 8 down to sort of 3 or 4, but getting it from 3 or 4 to 2 might be more of a challenge. So I think that's what you'll see in this week's figures. The core inflation expected to be unchanged annually, at least at 4.8. So again, that just tells you that you still have got some of those quite stubborn inflation pressures that are keeping central banks keeping them on edge a little bit. When's the next Fed meeting? Mid-September, I think, and we'll get a new summary of economic projections at that time, which means new forecasts. Their Fed funds rate's at 5.5, so that's same as us, highest since 2001, and who knows where they go from here. The Fed has guided to one additional increase from here, although markets are only pricing that in, partially. I think that's priced to the tune of about 30%. So the jury's still out, and some of the economic data will have a big influence on that. And this week's inflation report is no different. Locally, we've got the RBNZ survey of expectations. That's on Wednesday afternoon at 3:00. So that's been coming down, which is good. That's what we want to see. Tells us that people out there have confidence that the Reserve Bank will be able to get inflation under control. They're still credible. So that's important, and hoping to see more of the same. So that's Wednesday afternoon. And other than that, there's not much else. We might get a real estate institute report. I'm sitting around waiting for the what month is it? August. So the July report, which is usually comes out sort of on the 9th or 10th business day. So we might get it late in the week. You might get it Friday, or it might be the following Monday. But I've talked extensively about my views on the housing market. I think it's stabilised. I think the declines are behind us, so that's good. Prices aren't falling anymore. Good for confidence, good for sentiment. But at the same time, don't get your hopes up that prices are about to sort of rocket away on us. Still lots of headwinds, whether it's high mortgage rates, the potential for an uptick in unemployment, an economy that's still quite slow, the uncertainty of an election, and the fact that house prices are still far from affordable or far from sort of great value. The yields on rental property are still pretty average, to be honest, residential rental property. So for all those reasons, I think there's quite a big difference between a stable market where things sort of maybe slowly drift higher and sort of a very buoyant market. But we'll see. Maybe we'll get that on Friday. Maybe we won't. And outside of that, it's really the corporate reporting season. And across the Tasman, the reporting season starts this week. There's been a couple of companies that have reported already. We had ResMed last week. We had Rio Tinto the week before, but barely one each week in a market that big. It really kicks off this week. So you've got the likes of Commonwealth Bank, which is the owner of ASB. So they will be reporting, I think, on Wednesday. Boral, QBE Insurance, REA Group. So, a few Aussie companies set to announce earnings. Not too many here. Vital Healthcare, got them in the diary for Thursday for a full year result, but that's the only one. Things will really heat up for us the following week. So, this time next week, we'll talk about the reporting season, and there'll be a lot more that is looming. Internationally, things are starting to wind down, so it's a bit of a handover. The international reporting season's slowing, winding down and handing over to this part of the world. So far, about 84% of the S&P 500 companies have reported earnings, and most of them have beaten expectations. 79% have beaten expectations, in the tech sector leading the way with the highest beat rate, which is sitting at about 92%. So it hasn't been too bad. Still a few to go. I think there's about 30 odd S&P 500 companies due to report earnings, and there'll be others from other indices around the world. Zoetis is one of the ones that that I'm looking forward to. That's on Tuesday. Disney, that's on Wednesday. Illumina, also on Wednesday. And Alibaba, that's on Thursday. So a few big names there still to come. All right, again, I've talked far too long. So look, let's call that a wrap. Thanks for listening, and we will talk again soon.
For more insights, visit craigsip.com.